In this video, I'm going to reveal my entire UK investing portfolio, tell you how well I've performed in the last 6 months versus certain markets such as the FTSE 100, the S&P 500, and also reveal my best and worst investments. Also showing my capital returns and that with dividends reinvested. And all I ask in return is that you drop one of these for the YouTube algorithm. Firstly, I'd like to thank you all for joining and supporting this community. It's so incredible that we've managed to reach over 1,612 subscribers. I cannot fathom it. The fact that it's taken 6 months and we've gotten this much in our community already, it really means a lot. I feel that this community is only at the very beginning of its journey and there's a lot more to come. So hopefully we can all build up and grow together. Today, there's no top topics of the week, and instead the FTSE 100 has managed to gain 1.91%, the FTSE 250 has managed to gain 3.88%, the S&P 500 is up 3.27%, and my portfolio is down 0.3%, marking the second consecutive week that I have actually underperformed the markets. Although I'm really not concerned about these short-term market changes, as simply it's because my highest allocation is the one that is underperforming currently, and I suspect this is a short-term trend. Okay, so before breaking down my returns in the last 6 months, I'm going to talk about my current holdings, what stocks I own, and what I may be buying in future. Starting off the list is Halma, a technology company listed in the FTSE 100. Which I have owned since July 1st. Currently, Halma takes up the smallest amount in the portfolio, being 5.1%. This means that this stock is actually underweight to where I would like it. I would like this stock to take up 10%, and I'm likely going to be topping up this position as the year ends. Whilst my returns with this stock haven't been spectacular, this is because Halma returns shareholders with value by mergers and acquisitions, and for the first half of the year, they've made no mergers and acquisitions. I'm hoping that as the year goes on, they'll find all of these smaller companies that are struggling, perhaps they can get them at cheap valuations, purchase them, make them profitable, and generate returns like that. So I do think now is a good opportunity to be buying into Halma. This is a long-term growth stock with reliable dividend income, and there's really not much you can ask for when you're looking for a stock, especially in the UK. And this is a stock that won't be generating high returns in the short term, but over that long term, I do expect it to be one of my top performers. If you're wanting to take control of your investments, why not grab 2 free shares worth up to £100 each by signing up to Trading 212 using my link in the description down below. You sign up, click the link, deposit £1, and we'll both be eligible for a free share. And so if you are truly interested in stock picking, then don't forget to click that link. Next up is Softcap. This is a technology stock listed in the FTSE 250 that acts as an IT added reseller and IT infrastructure solutions provider. I've owned this stock since July 20th and subsequently is a very underweight position in my portfolio. Currently it takes up 5.9% of the total portfolio value, and my target allocation is actually 15%, which would make it my third largest stock in the entire portfolio. I currently only hold 70 shares, but I'm continually buying shares into this stock as it is one I really like. They regularly distribute surplus cash to investors in the form of dividends to increase shareholder value. Even though they're distributing the surplus cash, they've still got high growth potential as they're a very cash generative business and highly good at growing their earnings. Whilst this is my most underperforming stock as of the current holdings, I do suspect this trend will disappear. This is simply because at the moment there is a short-term lack of investor sentiment, and therefore the price has been slowly decreasing over the last month and a half. However, with the earnings update due on October 20th, I highly anticipate the announcing of their dividend that they had suspended in May, and also announcing their final dividend for the year, along with potentially a special dividend. There's a lot to go for with this stock, and I think investor sentiment has gone a long way higher to go. So each week for the last month, I've been regularly topping up this position, and I plan to do so, if not get a bit more bulk into it just before that earnings date. The second FTSE 100 stock in the portfolio is a company named Ashtead Group. They are an industrial leasing specialist that makes their profits by renting out their equipment to different niches in the industrial sector and make money like that. They've got a high domestic exposure to the United States, and that's another growth play on my behalf. This is a stock that in the last 10 years have actually outperformed that of Amazon. And to put it in perspective, they're also paying a dividend. Whilst I currently own 45 shares of Ashtead Group, that gives me a 9.1% allocation in the portfolio of my target allocation of 10%. And I feel that in the future, as we recover slowly from this pandemic, that this would be my recovery play. This is a stock that is currently trading at a very low price to earnings ratio of 20 times and realistically could be trading at a much higher valuation. This company is a lot more resilient than a lot of investors believe, and I think this will be shown over the next few years. The only issue with this stock is the fact that it can be cyclical, and therefore in periods of downturns, it's going to struggle. That gives us an opportunity to top up and build this position. Therefore, I'm going to look to buy Ashtead when there are weaknesses in the market or I see good short to medium term value. And I've held this stock since the 8th of June, making it my oldest position in the entire portfolio. The third largest position in the portfolio is London Stock Exchange Group, in which I have 15 shares. This is a stock I've owned since July 30th, and I've only put in the initial lump sum. Ever since, I've not made any top-ups. Currently, London Stock Exchange Group takes up 9.3% of the portfolio, making it probably the most balanced position I have, as its target allocation is also 10%. I've not been adding money to this as of late, as there is a lot of speculation. Whilst they are currently negotiating a deal, and the deal is going very smoothly to say at the moment, the price is held high. I do expect this share price to increase further if this acquisition of Refinitiv is successful. Refinitiv is a global financial market data and infrastructure provider. This would allow London Stock Exchange Group to increase their profit margins and also grow their earnings at a faster pace without limiting them just to their already current niches. The trade-off is that they're selling their Italian stock market arm, which has already been confirmed as of a few days ago. So this does look more promising that this will happen. I'm just going to top this up casually, keep it on my desired allocation, but there are bigger priorities first. This has a lot of potential to be a high octane growth stock that also grows their dividend at a very fast pace. What's not to love about this one? My second largest position is a company I've held since June 10th, making it my second oldest position in the entire portfolio. This is a company that pays a quarterly dividend, and they are called Games Workshop. Currently, they take up 21.9% of my total portfolio. The target allocation is actually 20%. I currently own 30 shares of Games Workshop. However, this is a stock that I will be building my position on every short to medium term weakness. This will be my second largest position, and potentially in the future may be my largest position if my investor sentiment switches. They are a company that regularly distributes surplus cash to their shareholders as dividends as well, and with a quarterly pair in the UK, which is already quite rare, that's excellent for me. They have such a large immersive amount of IP, which is intellectual property, meaning that they could expand out just from selling their royalties and their figurines to perhaps developing TV series, film sets. You get the idea. I do believe that this has the potential, if possible, to really expand out, meaning that I believe this stock has a lot of future potential, and that's why I'm so highly allocated towards it. There is a big bear case for this, and it's a hobbyist stock, that they're very limited and that their player base is aging and subsequently will be moving away in the future. But I feel that this company can expand. I kind of get a resemblance to Disney, although obviously not as family friendly on that behalf. The biggest stock in this entire portfolio, one that you likely have heard too much of and I try to keep quiet of as of late, this is Boohoo. They're listed on the AIM exchange, and I've owned this stock since the 9th of July. I own 2,000 shares, which makes it my biggest position in the portfolio, which takes up an allocation of 48.8%. My target allocation for this stock is actually 25%, so it is well overweight. However, after the earnings update, the stock price actually dropped. This has presented quite an opportunity. There's a lot of news going on around this company. They're really trying to push governance issues on it. I am not as confident on the bear case for it, and therefore will likely top up if this stock drops below 280 pence per share, in which case I would weigh up selling some of my other assets, siphoning profits off them to then purchase more of Boohoo. However, for the medium to long term, I'm likely just going to buy when I see value. And there's no way I plan on selling this one out anytime soon, regardless of what price it's at. If you're keen with maths, you would have noticed that these percentages actually add up to only 90%. So does this mean I've actually purchased another stock? Well, sorry to get your hopes up, but this isn't the case. With my target allocations, I've accounted for 90%. You may think, well, that other 10% would be for cash, and at the moment, that's the idea. Currently, it's nowhere near that. It's probably like a 2% cash position, but I'm going to let that one build up over time. However, this means I've got room to purchase a 7th stock, and there are a few on my watch list. So therefore, you may be thinking, am I finally going to convert and buy US stocks? Well, not quite yet. My reason for not buying US stocks is simply because I want to master the UK stocks first. I want to really understand this market, pick the best investments, and be so secure with these stocks that I would not worry about selling them even if they dropped 80%. And therefore, once I've done adequate research and I'm therefore satisfied with my stock picks, I will then be looking towards investments in the US. However, a few changes will be taking place over the next 6 months. Just because I'm not quite buying US stocks yet, I would like to start researching that market. Therefore, I'm going to start doing US stock analysis, and that will be starting at the end of this year. This allows me to really look into the markets, get a feel of that kind of market exposure with the US, and therefore slowly learn but not actually build a position just yet. I would also like to use a self-invested pension plan which actually negates the withholding tax. With a W8BEN form, I think there's a 3 in there somewhere, you can actually use this to halve the withholding tax from the US from 30% to 15%. However, in a SIP, you can completely get rid of this withholding tax. And therefore, to minimize my amount spent on fees, my SIP will be allocated to US stocks. But I will be honest, my biggest priority is maxing out that ISA allowance, and I don't think it's going to happen at least this year. During this time period, I've had some pretty terrible investments, but I would say I've got very lucky. This is because I invested mainly on the recovery play of our markets, and therefore, despite how bad of an investment I may have picked, they went up as the general investor sentiment went up. However, my worst performing investment had lost me minus 4.49%, or the equivalent of £43. This stock is named Shell, and you have likely heard me talk about this a lot on the channel. If you're interested in more in depth why I don't like BP or Shell, both holdings I used to have, then click the card at the top right of the video. Regardless, this is a stock that I really didn't understand. My issue with it is that I thought I understood it, but I didn't. Therefore, in the current pandemic situation, combined with the oil price war, I didn't really understand how severe of a situation this is, and I expected them to recover sooner than they did. I'd managed to sell this off on July 7th, I believe, and therefore, if I'd have continued holding this and not cut my loss, I would have been down a further 17.1%. which really marks a lot. And as for my best investment so far, that really has to be with Boohoo. Although I do feel why you may see this as unfair, as a large proportion of my portfolio is in one stock, therefore I could have just got lucky, and therefore my portfolio could just be propped up by one stock. Although I'm going to disagree, as I bought in when many people were panicking and selling out. I took advantage of this opportunity, and many of you guys did also. We saw a fantastic company that was trading at half of its price prior to the month, and with scandal issues that really didn't stick. And honestly, I would do it again. I'm very, very happy that I'd managed to have the conviction to buy in at that moment, and it may be another 10 years before we see an opportunity like that with a fantastic UK growth stock. Therefore, since I used this opportunity to build up my position, currently I've gotten returns of around 42.67%, making it my top performer so far. However, this is currently priced down after their earnings, as I mentioned earlier, and I suspect this will, over the medium to long term, really start to average up because investor sentiment needs to slowly build up. And they are actually down 10% from their highs of the last month, which is significant. So since creating this portfolio in April 7th, I've managed to make some deposits. My old ISA transfer from last year is equivalent to £1,495.24. And this year I've managed to deposit £9,750. I have 5 benchmarks to compare my returns to. This is the FTSE 100, FTSE 250, S&P 500, AIM 100, and the NASDAQ 100. I don't own any US stocks, so my goal is to actually outperform the US market without even holding their stocks. I thought that's a really good way to prove that you don't need to invest in the best returning index to actually do well in the markets. And in fact, globally, at least looking at the developed markets, I do believe the FTSE markets are actually the worst performing year to date. So that really puts something into perspective if I am able to actually beat these American markets. Firstly, I started this portfolio with a dividend focus, and I'm still a dividend growth investor. Whilst in the short term, I have a really high exposure to Boohoo, which is a growth stock and it takes up 48.8% of the portfolio, I still invest for dividends. I'm hoping over the medium to long term this position will scale back when I add more deposits, and therefore as these other positions get built up with my deposits, I can then really focus more on dividends. The idea is that these stocks that I purchase pay dividends, but they also grow their earnings at a fast enough rate that they're able to grow their dividends, at which point these companies are already growing their dividends at a faster than market average, and therefore once they slow down in capital appreciation, that their dividends will start to compound up and up. Therefore, the idea is that for whilst I'm young, I'm getting the benefits of having growth and therefore capital appreciating rapidly. And then as the future goes on and as the longer term is reached from the investments, that my yield on cost with these stocks will be spectacular and very exponential. And therefore it will increase and I'll have higher returns with my dividends. But it does mean in these first few years, maybe even decade, that I will need to be very patient. My dividend income is going to be substantially lower than many others that invest in things like AT&T or Legal & General with like 8% yields. So in total, since creating the portfolio, I've managed to get a total dividend income of £60.34, which isn't good, but it isn't bad. This is pretty impressive when you think it's on average around £10 a month, and my sim-only contract is £10 a month. So therefore, in looking at financial independence standards, in theory, that bill would be covered indefinitely for the rest of my life. However, obviously we would like this to grow further so that then this could cover more in the future. But then also we do need to look at the monthly trends, as I did have different holdings earlier and therefore they really bumped up my yield as I transitioned from these high yielding, lower growth rate stocks towards these lower yielding but much higher dividend growth stocks in the UK. Regardless, at the end of October, I will be receiving another dividend from Games Workshop, which should bump that up to around about the same total as September last month. However, when you look at this graph, you can see that in June I had my highest amount of dividend income, and it's likely I will not be hitting this for a while. There is also gaps in my dividend payments. This means I will not be getting monthly dividend income anymore. This means that in April, June, July and August each year I will not be getting any dividend income. However, my hopes are that as the UK transitions, that more companies are actually quarterly dividend payers. An example of this would be London Stock Exchange Group. I see no reason why they couldn't transition, especially after this potential merger / acquisition with Refinitiv. I do think that that would be such an incredible move to make. Similar approach for Ashtead Group. I do believe, since they are making these reports quarterly, that all they need to do is really get their reports audited on each quarter, and then a quarterly dividend payment would be much appreciated. Although the only downside with this is that their free cash flow would be restricted, and if that's an issue for some of my companies, I understand why they may not want to do this. Now for the juicy part of the video, the one that you've been waiting for this whole time. Did I beat the market and the fund managers? Well, yes and no. I'd like to disclaim firstly that these calculations are not going to be 100% accurate. However, with a 90% certainty, I can confirm that these are around the ballpark of where my returns would be. Here are a few of the errors that I could imagine that will slightly impact these exact percentages and therefore make it more of a rough guide. This is including things like not including dividend returns from the markets. So for instance, the FTSE 100 is going to look a lot worse than it actually is, since it is a higher yielding market than all of the others on this list. Whilst I've done a growth only perspective, my growth figure may be propped up by some of my dividend income that I have reinvested, and therefore from a standpoint that may be slightly inflated, although my dividend income isn't that high. Also, there's an issue, and until FreeTrade upgrades their software, and I don't doubt they will do this in the future, I'm not able to track the weighted returns of my portfolio, effectively meaning when I put cash into my portfolio and when I withdraw it. I don't plan on withdrawing, but that's the point. So the idea is that as I deposit money, it'll be able to track where the markets were at that point, but there's no benchmarks to compare to. So what this is doing is assuming that on April 7th, my total current portfolio value was immediately invested and it was left. Whereas I've actually been consistently putting small sums of what I can really afford into the market and letting it settle. And so this would mean that the FTSE 100, which has been trading sideways since late April, effectively means that their market returns won't look as impressive, but the US markets that have gone like diagonally up and done really well, or been pumped, for instance, those American markets are going to have higher than average returns. Regardless, in this time frame, the FTSE 100 since April 7th has generated a return of 5.47%, which is quite depressing really, but I do understand why, and it's tied up to these big dinosaur companies with little to no growth potential. And if you're interested in why I think you shouldn't buy the FTSE 100, then click the card at the top right of the video. The FTSE 250, however, has done better with returns of 16.09%. Honestly, would be a respectable target to beat, but it's not quite anywhere on the level of the AIM 100 or the S&P 500. The S&P 500 in this time frame has generated a return of 30.75%, and the last two ones, such as the AIM 100, has generated returns of 38.68%, and the NASDAQ 100 has generated 45.68%. So where does this place my portfolio in the rankings? Firstly, if we look at Simply Wall Street, however, I'm going to tell you this now, this is extremely inaccurate, but I would like to give two different perspectives on my returns. If you look at it, it's massively incorrect, and it says I've got returns of 15.68%, and I'll explain exactly why it's incorrect. That's because over this time period, I've had something like over 20 different stocks. Once I'd sold these stocks, it assumed that this money wasn't reinvested into my current holdings, but rather I just magically kept it as cash and just didn't invest it. So therefore, 15.68%, it might be returns based off of a total cash position of something much larger than the money I actually have. But when looking at my spreadsheet, we can see that I've generated returns of 27.31%, which puts me ahead of the FTSE 100 and the FTSE 250, which is where a majority of my investments are located, not ahead of the S&P 500, although I was beating it up until Boohoo had then started choking the last few weeks. Still not got close to the NASDAQ. And the AIM 100 is my next goal to beat after that. Sure, currently I could have gotten better returns by investing in a passive index fund of the NASDAQ 100 and forgetting about it. But there are a few factors that do need to be considered first. To start, hopefully you've noticed that all of my current holdings were actually purchased in June and July. But I started the portfolio in April. I made some serious mistakes, which means that the opportunity of this had actually cost me quite a bit. This means that whilst many of the markets had gone significant easy gains, I didn't hold these current stocks. And therefore, in that perspective, I am underperforming from an opportunity cost basis. Also, the UK markets aren't currently being pumped up by a Federal Reserve. Whilst yes, the Bank of England is doing some quantitative easing, it's nowhere near in scale or comparison to the Fed and the US markets. This is combined with the fact that the US markets have had a fall in the dollar, which has increased their value. I still feel that we're heavily priced down for Brexit, and so I believe in this time period it's very understandable that I'm underperforming the American markets. This is still very short term. I'm not just going to quit after 6 months, as this really doesn't show what I is. I am a long-term investor. I look for a time period of longer than 6 months. If I'm underperforming the market consistently for the next 5 years, then I'll accept it. You know what? I won't be a stock picker. I'll sell all my investments and then purchase index funds that track the whole world. But I strongly believe that this will not be the case, and that over the medium to longer term, that actually these American markets that have been consistently going up and up and up every single month will start to slow down, stagnate, or even start to decline, whereas the UK at least won't be priced down by Brexit. At least then I hope that my portfolio will then get ahead of these markets, but only time will tell. Hopefully things are going to get more exciting in the next year half. As of next week, I'm going to make the portfolio fully transparent again. I was too over ambitious with the topics, trying to do 5 educational topics at once each week. So it'll be a condensed format where you can see the portfolio, my thoughts on the holdings and what I'm buying. I'm also going to start doing US stock analysis at the start of 2021, so make sure to be subscribed for then. And there's also a Discord currently in the works, which means we can all interact and communicate as a community, and I think that will be the next step. And after that, I'm also creating a Patreon. However, this is more in the distant future, so I'm still trying to find ways to really add value behind it. And at the moment, I haven't got those reasons. I would just like you to know that in the back of your mind that this will be a plan for the future. Thank you all once more for the support you've given myself and this community, and hopefully we can continue to grow and build this community in the next half of the year. We've had a really strong first half, and yes, I have underperformed that American market, but we can still pull together and do well. Thank you for watching. I'm Osborne Foreman. Stay safe.